Welcome to Principles of Macroeconomics, Lecture 7, Taking the Nation's Economic Pulse. Now we will cover GDP, or Gross Domestic Product, a measure of output. As this is a course in macroeconomics, it is important that we learn the key tools used to measure an economy's health. One such tool attempts to measure the value of a country's output. We call it Gross Domestic Product. GDP is the total market value of all final goods and services produced within a country's borders during a specific period. GDP is a measure of how much value a nation's economic system is producing over a specific period of time, so it is a flow rather than a stock variable. By counting the value, measured in market prices, of final goods, we can determine the value added in all prior stages of production. Let's look at a GDP example of bread production. Although GDP accounting sums the prices of all final goods and services, the price of each good represents the total value added by all stages of production. So, for our bread production example, in the first stage, a farmer harvests wheat and is able to sell it for 30 cents a unit. So, the value added by the farmer is 30 cents. And the miller turns the wheat into flour and sells it for 65 cents a unit. So we can calculate the value added by the miller by taking 65 cents and subtracting out the price he paid for the wheat, which is 30 cents. This totals a 35 cents in value added. We continue on through these steps. For example, in stage 3, the baker turns the flour into bread and can sell his bread to a store at 90 cents a unit. This accounts to 25 cents in value added, and finally, a retailer like Publix can sell this bread to the end user for $1. So Publix adds 10 cents in value by bringing it to consumers in a marketplace. If we sum all the added value at each stage of production, we arrive at the final market price of $1. So what do we include in GDP calculations? First, only final goods and services count. If we count goods that are in intermediate stages of production, we will engage in double counting. For example, tires sold to a consumer are counted, but if those tires are sold to a car manufacturer by a wholesaler to put on, let's say, a new Chevy, we only count the final price of the vehicle as it contains a value added by the tires. So we don't want to double count this intermediate good. Secondly, only transactions involving production count, because we only care about the value added by the production process. So financial transfers, welfare payments, and the trading of stocks and bonds is not counted. Thirdly, only production within a country's borders are counted. We do not want to include the value of a Hyundai Sonata if it is produced in Korea. And lastly, only goods produced during the current period, usually a fiscal quarter or year, are counted. The sale of used goods is not counted because it was already included in previous calculations and there was no new production. For GDP accounting, dollars are the common denominator. Each good produced increases output by the amount the purchaser pays for the good. Goods and services are very different, but their value can be summed as a result of a common currency. There are two main approaches when calculating GDP. One is known as the resource cost income approach. We have been discussing the expenditure approach when we consider adding up the prices of final goods and services that consumers pay. But for each action involving an expenditure, there's another party earning income. Thus, the dollar flow of expenditures on final goods has to equal the dollar flow of income from the sale of final goods. To calculate GDP using the income approach, we simply sum the following income components. We add wages, rent, corporate profits, interests, and we also have to add in indirect business taxes, depreciation, and a net income of foreigners. And we have to add in indirect business taxes and depreciation because a firm subtracts these two components from their profit. And so we have to add it back in for total GDP. The more popular approach is known as the expenditure approach. This second method involves adding up the total expenditures on all final goods and services produced. We include the following components. Number 1, consumption spending. This is the largest component of GDP, and it makes up over 2/3, or about 70%, of the GDP of the United States. It includes household spending on consumer goods and services. Next, we have private investment, which measures the flow of private sector expenditures on durable assets plus net increases to inventory. These assets are used to produce consumer goods and services. For example, they may include machinery, store inventory, or even homes by consumers. Now, the reason that homes are included in private investment is because we will have a future flow of rent services which will come from the households. Nextly, inventory is important to include as it contains value from current production, even if the products are not sold in that period. Next, government expenditures. We don't have a good way to add in the value of government spending, so we add the costs of government activity. And finally, we want to include net exports. That is, total exports minus total imports. We want to include goods that are produced here within the border of the United States and shipped abroad, while subtracting out the goods produced overseas. I think it is helpful to look at the relative size of GDP components from 2005 to 2008. Personal consumption made up about 70% of total GDP. Government expenditures came in at about 19%, private investment made up 16%, and net exports were actually negative, at -5%, because we import more value than we export. Now we will take a look at real GDP, which is adjusted for the average level of prices in the economy. As economists, we only care about real goods and services that are produced, so changes in the average level of prices can be problematic. For example, if we produce a car this year that's valued at $20,000 and produce the same car next year that sells for $30,000 because of increasing prices overall, then the real value of the car does not really increase, but rather it is a result of higher overall prices. So real values refer to the values of products after adjusting for inflation, or the increasing level of prices. Two measures of inflation can help us calculate real GDP. The first method is called the Consumer Price Index, or CPI, and it measures the general level of prices by comparing the cost of a typical market basket of consumer goods, and it follows this basket over time. Next, we have the GDP deflator, which is a broader measure of inflation because it measures the average price level of the market basket of goods included in total GDP. We can calculate the rate of inflation, or the change in the average level of prices, by using the percent change formula applied to price levels. So the inflation rate is equal to the current price level minus the previous price level, and then we divide it by the previous price level. We then multiply what we get by 100 so that we can get it into percentage terms. Now we need to figure out how to calculate real GDP. So far we have been referencing nominal GDP, which is simply a nation's GDP in terms of current dollars. When we compare GDP over several years, we need to adjust for inflation. This adjustment leaves us with real GDP. For example, if we have GDP for the year 2000 in year $2,000, and we have GDP for 2008 in terms of $2008, we will need to convert 2008's GDP figure to be in year $2,000. This would result in real GDP for 2008 denominated in year $2,000. This enables us to compare these two figures using dollars with common purchasing power, accounting for changes in price levels. So we take real GDP for 2008, and we can calculate this by taking the nominal GDP in 2008 and multiplying it by the ratio of the GDP deflator in year 2000 divided by the GDP deflator for 2008. Although GDP accounting is very useful and it's a nice measure used by economists, there are a few problems with GDP accounting. First of all, GDP calculations are not perfect because it does not consider non-market production. Only official exchanges are included. So if your spouse cooks a meal for you within the household, the value of the meal that was created is not included into GDP because there was no official market transaction. Number two, it does not include goods and services produced in the underground economy. This usually occurs in a black market. 3. It does not account for leisure time, so even though we may be more productive and we may be producing more goods and services, it does not account for the fact that we may not have a lot of vacation time or time to spend with friends and family. And number 4, it does not account for changes in quality. For example, new laptops are usually faster and more sophisticated than old ones, but they do not necessarily cost more.